The best companies for long-term investors to invest in share common attributes. They have consistent long-term earnings growth, like we see here with Johnson & Johnson. We also see that with the company Global Payments, where they grew their earnings, the orange line on this graph, year after year after year, very consistently at a very high rate. And we also see it with companies like Elevance. Year after year, their earnings grow. But the best part of this is, in the long run, the stock price will follow that earnings growth. But there will be times when the price gets below the intrinsic value of the company represented by the orange line. There will be times when the price gets above the orange line, which are less than optimum times to invest. But the real key is companies that share these attributes generate very strong long-term rates of return. Elevance, since January 31st, 2003, turned $10,000 into $149,000 of capital appreciation, plus $11,000 of dividends, turned $10,000 into $160,763, averaging over 14.5% per year long-term growth. And the best part of that is that's very, very consistent with the long-term growth of the company. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. And, one of the most common questions I've received, and I've been doing this for actually since 1970, so it's been well over 50 years now. The one question I get is, how can we find the best companies to invest in? And by the way, that's a two-step process. Not only do you want to find the very best companies like the three I showed at the beginning of this video, companies that have, very common attributes or very important attributes, consistent earnings growth, consistent dividend growth if they pay a dividend, strong fundamentals, low levels of debt in many cases. The key is, how do you find these great companies? But then not only that, how do you find them when the valuations make sense? How do you find them at the optimum times to invest in them so that you can basically participate in the full measure of whatever type of growth and profitability and results that the companies in question can generate? Well, Fast Graphs has always been a great tool. It's a tool that allows investors to analyze stocks like that, like the three I showed you here. But the problem is that Fast Graphs really never, till today, I might add, have really been able to give investors the ability to find these kind of great companies. So let's go ahead and go into the Fast Graphs here, and I want to point a couple of things out to you. I want to start with the portfolio feature for our premium subscribers, and these are called preset portfolios. And what you see here are 14 portfolios that are comprised mainly of major indices like the S&P 500, the S&P 100 large cap, the S&P 400 mid cap, the S&P 600 small cap, of course, the Dow Jones Industrial Average, the NASDAQ 100. But we also have things like the S&P Dividend Aristocrats that have increased their dividend for 25 consecutive years. And then we have the challengers or the champions, contenders and challengers that have increased their dividends for 25 years, for 10 to 24 years, and for 5 to 9 years or more. These are all very excellent companies, but the problem is, you can go into these portfolios and you can identify these great companies. For example, if I go into the S&P 500, the three companies that I featured in the video so far will be found here. These are the best companies. Companies have to meet certain criteria and certain objectives before they can be included in any of these indices. But I'm very proud to say that Fast Graphs has been working the team at Fast Graphs has been working very diligently, creating a screening tool that will easily allow subscribers and investors to find the right kind of companies to invest in. But not only the right kinds of companies to invest in, but also be able to identify them when they're at fair value or reasonable valuations. So what we've done is, the first thing we've done is we've taken these preset portfolios that I showed you earlier under our portfolio section, and then we've generated screens so that we can identify the best positioned stocks in each of those screens. So all you have to do now is click on the name of the screen. Here I'm looking at the Dividend Champions, and these are companies that have increased their dividend for 25 years or more. And then we can easily find a small list of 13 companies currently in this case that allow investors to screen or to look for companies that are fairly valued that meet their criteria. For example, if I look at Altria, which is the old Philip Morris, and I bring in price and I bring in the normal PE onto the graph, we're able to see that Altria has these characteristics: consistent earnings growth, just like we saw with J&J at over 7%. And we see periods where the stock is undervalued, overvalued, and then undervalued. And we want to be buying it when it's undervalued. Now, this particular company yields 8.29%. So it's a really excellent vehicle for the income investor. And if that's what you're looking for, the tool now brings that to you. But if you're looking for something a little more growthy, we'll call it, then the screening tool also includes names like Carlisle companies that have double-digit earnings growth. They've got good recent momentum, and they're still trading at a valuation that is under the orange line, offering, some potential going forward. And all of these screens are built on what would be the future. We're looking at past, we're looking at present, but we're also looking at the future. And you take a company like Cardinal Health, and it's just maybe a smidgen overvalued now, but I chose this example because Cardinal Health, and I just did a video on names like AT&T and Verizon, and I've done videos on others where the stocks were undervalued. I want you to note that Cardinal Health was an undervalued stock, all the way back to 2017, and it stayed that way all the way through 2022, actually November of 2022. But the point is, this was a great time to be buying the stock, because even had you bought it here, when it still had room to drop and held it till today's price, you'd be making almost 9%. But had you bought it at any of these low valuations, now you start earning things like 16.27%. Because like I say, valuation matters, and it matters a lot. But going back to the screening tool now and looking at, going into these preset screens, you can also go to the dividend contenders. Here we've got 56 stocks for you to look at. But here you can see, and you can sort these by things like the ticker. So I'll look at a stock like Assurant, and here you see that, reasonably consistent growth, a little more cyclical, but you see very, very good valuation now and about a 2% yield. You would also have in this screen a name like Ameriprise, which is a financial that has been also a very consistent grower at double-digit rates. And it too has current momentum, and it's trading at a relatively low valuation. And then you're also going to find things like utility stocks, like Edison International, that are relatively slow growers, and their growth was 3 or 4%. And I kind of mentioned this in a previous video, but they offer you a 4% yield. So any investor, whatever your goals, objectives are, will be able to find companies that meet the criteria by going through these preset screens. Now, I'm not going to go through all of these screens with you, but I am going to show you some of the variants that you get. For example, if you go into the simple Dow Jones, the 30 stocks in the Dow Jones Industrial Average, roughly half of those stocks are good investments right now. And you've got, really good names like Amgen, for example, that Amgen really meets the criteria. Now, Amgen's a classic example of how you can overpay for even the greatest company and go through an extended period of time of actually losing money, even though the company had unbelievably great earnings growth. You can see 37% earnings growth, 27%, 33%, and then even when it got into 2% earnings growth, the stock was really undervalued. But had you bought the stock when it was undervalued like this and held it, even though it's undervalued today, you'd be averaging over 15.76%. So, we're showing you the company that has the attributes that I talked about in the beginning of the video: consistent earnings growth. We see that they started paying a dividend in 2011, and that dividend has increased every year, and they've paid that out to their shareholders. And then the long-term rate of return, if this stock was bought at an attractive valuation, has been, very, very good in terms of dividend income as well as capital appreciation. And that's the key. You want to buy the stock when the price makes sense. Then you get the full measure of the growth of the business plus the dividends, even though the stock is undervalued. And just a few months can make a big difference. Buy the stock here at the beginning, hold it to where it was slightly overvalued, you make 12.65%. But today, buy the stock at that same point, and now that the stock is just a little bit undervalued, now all of a sudden your rate of return is 9.5%. That's still very attractive. But one of the points I want to make, and this is a classic example, overvaluation reverts to the mean. Undervaluation reverts to the mean. So what we're doing here is we're giving you the opportunity now to find these great companies when you can buy them at attractive valuations. And we've done it by screening these really great portfolios here. Now, if you're looking for more aggressive stocks, you can go into the small cap portfolio. And here's 25 stocks in the small cap portfolio that can be very exciting if you're a growth investor. Stocks like Astec here, which are very cyclical, you can look at, but the future forecasting is for them to grow at a very high rate. Now, that you'd have to do some due diligence. I point this one out because it's not the perfect company. But if you look at a company like Allegiant Travel, you've got these extraordinary growth rates going here. And if you look at the history of Allegiant Travel, they obviously suffered during COVID. But since COVID, travel, as you know, has been booming. And this stock has really been on a tear with growth averaging over 69%. And, what a great time to be looking at this stock, assuming that it continue to grow like that. And by the way, using fast graphs, you can go into Yahoo estimates and look at long-term growth rates that they're forecasting. They're also forecasting 85% growth. So here's a case where you can identify and find a really fast-growing company to invest in. And this would be a small cap. It's got a $2.3 billion market cap. It's got reasonable balance sheet, 54% debt. It's only B plus rated, but if you're an aggressive investor, you can find stocks that fit your, criteria to invest at, very low valuations relative to their future growth. You can also look for, find companies in this small tech like AZZ, which is building products, again, reasonable debt, a market cap of $1 billion, forecast to grow at over 14% going forward. So, if you're a growth investor, yet with a dividend kicker, this might fit your bill. And then you can even find companies like Bloomin, which is better known perhaps as Outback Steakhouse, and they came out and recapitalized. And look how valuation works. They came out with a new IPO, and like most IPOs, it came out with hype. And then the stock, for the next 2 years, traveled back into a reasonable valuation. Then, of course, COVID hit, and that shut their doors down. But then since coming out of COVID, their earnings have recovered, and their earnings are beginning to grow again. And you can look at the company now with a 3% dividend yield and expected growth rate of over 11%. Fast Graphs now gives you the opportunity with these preset screens to find these kind of companies that you can invest in. You can go into things like the NASDAQ 100. And here you've got Amgen again. You've got Cisco, which is one of the better, NASDAQ stocks, AA rated, 14% debt. And again, you can see that they have the attributes that, we're looking for, consistent earnings growth. And then since they started paying a dividend, consistent dividend growth. But the point is, there are times when Cisco becomes a very poor investment because of high valuation, even though the company's doing well. The secret is buy the stock when it's cheap. And what's nice about Cisco right now, for those of you who are a little more squeamish, you can buy Cisco with momentum. The stock for the last year or so has been doing real well. From the bottom, it's gone up over 40%, but yet it still remains undervalued. So you can find, names like Cisco in the NASDAQ 100. And you can go through, the mid-cap portfolio as well. So you can go into the screener, go to the preset screens, and go to the S&P mid-cap portfolio. And in the mid-cap portfolio, you can find names like National Fuel and Gas, which is more of and people have asked me about this is more of a yield stock. It's kind of been low growth, but all of a sudden, growth has been accelerating. And now you can buy that with forecast growth of over 11% a year longer term, and you can buy the stock at a PE under 10 with a dividend yield of almost 4% and a good history of raising dividends. So you can find a little bit for everybody, whether you're a growth investor, a dividend investor, a high yield investor, a dividend growth investor, a pure growth stock investor. We now offer screens that can allow you to identify those. And in addition to these preset screens off of the preset portfolios, we also offer some additional screens like good growth, with a good long-term rate of return. And here you can find companies that, are like Global Payments, which I showed in the beginning, and Federal Express, which is coming out of a down year in earnings and expected to grow very strongly. We also have another growth screen that I think you'll find attractive, which is growth in returns, fairly valued, undervalued, that are with estimated 15% or better growth rates. And here again, you've got 30 stocks that meet that criteria that you can look at, even names like Meta or Facebook. And you can see Facebook's been on a tear, and the company is just now getting outside of its original value range, but it's still expected to grow at very high rates going forward. So what I'm really excited about here is the new screening tool can help investors that are FastGraph subscribers immediately identify a list of stocks. Now, you can also go into the screener and create your own screens. And we're going to do another video on that. I'm going to have my son Colton come in and do a video on how to run that. We do have a tutorial that I'm going to put a link to at the bottom of this video. But anyway, this has been Chuck Carnevale, co-founder of FastGraphs. I'm very excited to offer this new feature. Now, not only has FastGraphs given you the ability to analyze virtually any company in the world, if you subscribe to the international stocks as well as the U.S. stocks, you can do that for a mere $10 upcharge from the premium subscription. Premium subscribers can now get a list of preset screens where you can identify the very best stocks in the highest quality, the best attributes, the best metrics, fundamental strength, and good valuations for your research needs. And you don't have to be searching all through the thousands of companies any longer. We're very excited about this feature. We're going to be expanding on this greatly in the future. The screening tool is going to be developing as well. We felt this was so exciting, though, we had to launch it now where we gave you these preset screens, but we're also going to be creating many other powerful features in the screening tool. So if you don't subscribe already, please take a look at FastGraphs. You can take a free trial and see how valuable this tool can be to you. And if you like this video, please subscribe to the channel, give me a like. And, obviously, I want to thank all of you for looking at this. FastGraphs now not only gives you the ability to analyze any stock in your portfolio or any stock throughout the world, it now gives you the very best, highest quality, best valued stocks, recommendations on ones that you can add to your research process. Thanks for watching, and appreciate you all.